Looking at the way the market is behaving these days, some investors may be thinking of exiting the market. What is the ideal exiting strategy? We will discuss this in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Market is shaky these days, and I, as an investor, want to get out. Am I right in saying that?
No.
No.
In fact, market should not guide your investment or disinvestment. In fact, your investment strategy should be such that it should be despite the market. In fact, if you're a long-term investor, getting out of the market could be extremely risky. Because if you get out, this is the time, in your investment time frame, if you're investing for 20 years, 25 years, or 15 years, you get phase where you are able to buy things cheap when things are turbulent, and that is when you are able to accumulate things cheap. If you're a short-term investor, if you accidentally drifted into the market, if you just accidentally invested in some fund because it was going up and you just got attracted to it, and then by all means, if you're still sitting on gains, get out of it. You should not have been there in the first place. Everybody should have a plan for your and should have the appropriate investment vehicle. Investment for few days, few months, you should have fixed income funds. Investment for few years, you should have equity. First time investor investing for few years, they should start with hybrids. And and you should not be guided by the market. If you are getting attracted to the market because of the market, or if you are getting scared by the market because of the state of the market, you are not meant to be in the market in the first place.
So let not your market fluctuation depend whether you will remain in the market or not. Rather, it should be the goal.
Yeah, you have to stay for the long run with your equity investment, and that is how it. And then you have to be investing regularly to benefit from all this noise. When markets get shaky, then you are able to buy cheap. And that is all that you can do. If you are trying to time it, that okay, now it has gotten shaky, so I'll get out of it and try and get in again, I think it is a very risky strategy. Nobody has been able to perfectly time it. You will miss some of the biggest opportunity, because in a long period of time, 10, 15, 20 big occasions, they come with a surprise, and that is when you actually make most of the gains. Okay. So the gains are concentrated in few days.
So okay, if you reach the financial goal and you have kind of come closer, okay, not reached,
Yep.
okay, come closer to your financial goal, what should be my exit strategy?
Oh, it's fairly straightforward. If you are investing for a goal, or if you are investing for income, because that is also a methodical exit, which means that you have to continually exit to, for your investments to be providing you regular income. That is what most retirees will require. Things are pretty straightforward. As you invest regularly, you should disinvest regularly as you get closer to your goal, and that time frame should be 6 months to 12 months before you need the money. Okay. You should start methodically exiting your investments. Say if you are, and then most of the things are in your hand. You have the best information. Only you have the best information. For example, if you have accumulated investments, savings, if you have saved for your child's education, and he's getting into the college for next 4 years, you need the first year's fee 1 year from now. Start preparing for having liquid, money in fixed income fund, right, which will be insulated from the market over the next 12 months. So if you need 5 lakh rupees 1 year from now, take out 40,000 rupees every month, so that you have 5 lakh rupees free of anxiety, lying in a fixed income fund which can be brought to your bank account at a day's notice, and it will not be dependent on the state of the market. So you go on methodically like that. You need regular income from your investments. Work on a withdrawal plan of a regular kind. Make sure, we have talked about it many times, that what should be your scale of withdrawal, how to do it so that you don't run the risk of outliving your savings. So that's about it. Be methodical about your investments, be methodical about your disinvestments for a specific goal, one-time goal, negotiable, non-negotiable. Prepare 1 year before, and don't over prepare. Okay. If you are actually taking a lot of money out and it lies idle, or it's not working very hard after you have taken it out, that will also be counterproductive. So do some budgeting, prepare for it, and prepare any time between 6 months to 12 months.
Okay. And what about the withdrawal plan to meet the need of regular income? For example, say retirement.
Yeah. As I was saying, that work on a methodical exit plan, which means a withdrawal plan. And as we have talked about in the earlier episodes of this Hangout session, that what should be your withdrawal percentage. My sense is that in India, 6% annual withdrawal rate will ensure that you will be able to increase your income over time. You should be able to ensure that you do not outlive your savings in your lifetime. That's one. You will have your capital intact. That apart, your capital will grow in a manner to support inflation adjusted higher income. So this year you need, say, 50,000 rupees a month, and 2 years from now you need about 55,000 rupees a month, because of rising inflation, cost of things or services that you consume, that would have gone up. So investing in a manner so that it can support, so something which is equity linked too, and those things you should have. And there are two ways of dealing with it. Either you take the money out which you require in the next 12 months every year, so that you don't have to worry about what time of the capital. Don't try and time it, or do nothing. Have a monthly withdrawal plan, a plan which does not, make sure that your withdrawal rate is never exceeding 6% every year. If you go beyond 6%, revise it. 6% will be a higher amount if the market, if your investments do well, and that will be more than enough. But to begin with, make sure that your investment withdrawal is never, your regular withdrawal, income withdrawal, is not exceeding 6%.
Okay, that is for the retirement. And if you have a negotiable goal, then you can be a little flexible in that.
Yeah, but there are 2-3 ways of, there's one other way, for example, a negotiable goal could be, planning to buy a house, which you can buy anyways. You can have a time frame that, in 3 to 5 years time you would like to have that, or you want to upgrade your car, and next 3 to 4 years you would like to upgrade your car. So these are negotiable. It can happen at 2.5. If your investments do well, and if you are investing with a specific purpose, that this investment is going, it is a targeted investment. If you have gotten lucky, take that money out, have that gratification early, prepone your plan. Otherwise, if you are approaching that goal, then start taking that money out methodically. If you have planned for preparing for the down payment of your house 4 years from now, so 6 months before that, move that money into fixed income, and then go house hunting.
Okay, so Dhiren is saying that 6 to 12 months is the time frame over which you should spread your withdrawal.
Yes.
Okay, we now move on to the Q&A part of this episode. Ramavani has written, I'm 5 years away from retirement. Please advise me how to invest in the current financial year for my retirement corpus.
You need to really plan about things, not just for this financial year. You need to plan for things. So do some basic budgeting in terms of, will you be getting a pension? Do you have any other supplementary income alternative? For example, if you have a house which is from which you derive a rent or anything, so that's one. Depending on that, so, and whatever, you have to really look at your lifetime savings that you have accumulated so far, and the likely income you require to support your living. So regular income from your investment. Do this. You should not be taking an annual view that what you should be doing in this financial year. You need to really look at the asset allocation, think in terms of all the accumulation that will happen from your provident fund, from your if you are actually encashing a part of your pensionable pension account. So those things. Do this budgeting, see how much corpus you will have, what is the tentative income requirement, and next 5 years look at what the gap is and how much can you fill. And if also consider, there is a possibility that you may not have any market linked investment. It is important to have market linked investment because they are the only hope for retirees to beat inflation. But at the same time, they are risky, and they are more risky for somebody who has never tried them, who has never been used to it. So think in a, access them, invest in them in a more conservative way. Consider, lower allocation funds, for example, the conservative hybrid funds or debt-oriented hybrid funds. Start with them and do it over the next 5 years. I think you need a more elaborate planning than just planning for the next financial year.
Since it's not mentioned whether he's a government servant or a private, so what we are saying is that sense of urgency should come in, because 5 years actually...
5 years is not a long enough period. In fact, anything less than 5 years, I generally recommend that they don't even consider equity. But the good thing is that, you will have all the accumulation or all the savings that you will do. You will retire in 5 years, and after your retirement, you will require a very nominal income from the date of retirement. So it is that, your money is still going to be invested for the long period of time.
Right.
It is going to be invested for all the period for which you will live, and you will require income support. So in that sense, you are still a long-term investor. It requires careful planning, do some totaling up.
Right.
Money that you need and money that you have.
What worries me, Dhirendra, is that what about the medical expenses? I mean, day-to-day expenses is fine.
Yeah, it requires careful planning, because it all varies. If you are a state government employee, or if you're a state central government employee,
it really makes a difference.
It makes a difference. What kind of, and the absence of long-term healthcare plans in India makes it very difficult.
Right.
Also, I feel that this is one area which has become very tricky, and it is going to be one of the biggest surprise for people retiring.
Abhijit has written in saying, for a long-term horizon of 20 to 25 years, what should be the focus of investment? Large caps, mid caps, or small caps?
I would say that there are 2-3 ways of looking at it. In fact, all of them can be weaved into a plan. But I would say that build your portfolio with large and mid cap fund or the multi-cap funds. That should be the foundation of your portfolio. And then supplement it with one mid cap and one small cap fund. Make sure that those don't dominate your portfolio. So in the worst of times, those funds will actually take care. They will provide the resilience. So if you are actually having 4 funds, that will be good enough. A multi cap, keep it simple, and and 20-25 years. Small caps and mid caps definitely hold promise. Mutual fund is the way to go, because they are risky category, they have mortality, but they also they turn out to be blockbuster over a long period of time, and you require patience, because these small caps and mid caps, when they fall freely. So that is why they should just be the peripheral of. So make sure that you are doing it in a calibrated way. Multi caps, mid and large and mid caps should be the foundation. Supplement it with small and mid caps.
And Abhijit has time.
Yeah, has all the time, and 20-25 years. I think this is going. Hopefully, the next 25 years is going to be one of the finest period for the Indian investors investing in equities.
V. Balaji has written to us saying that please guide me how to invest rupees 1 crore retirement corpus to get regular income for monthly expenses of 50,000 rupees.
The simplest plan will be invest your 1 crore spread over next 3 years into a balanced fund, into a conservative hybrid fund. This might look like a very aggressive strategy, and but I'm sure that 50,000 rupees monthly withdrawal plan, and if you are able to average it over the next 12 months, 18 months, 2 years to your comfort, it is important not to invest at one go. If you invest at one go and the market faces a 15% decline, you will be in for a surprise and your capital will be impaired, and that is the time when you will also be doing a withdrawal of 6% on your 1 crore. And this 1 crore
SIP over a period of 3 years.
SIP over a period of 18 months to 3 years, depending on your comfort, because I think that averaging at this point is important even in balanced fund. And after that, do a systematic withdrawal plan of 50,000 rupees. Spread this money over maybe just 2 funds. That will get you enough diversification spread. So this is a relatively aggressive plan. And this will ensure, I'm hopeful that over the next 10, 15, 20 years, you will be able to increase, because your requirement is 50,000 today. 2 years, 3 years down the line, your requirement will be 55,000-60,000 rupees a month. So this will be, this plan will actually be able to support that need for rising income with inflation.
Okay. Ashray has sent in this question. Interesting, since you've been talking about balanced fund, Dhiren, and this is related to that. We invest in balanced funds as they are safer than pure equity funds. But what if the debt portion of the portfolio underperforms at the same time when equities are volatile?
Underperformance and losing value. Debt is also volatile many a times, but understand the character of it. In case of fixed income, the volatility works in a it is anchored to some value, because every bond, every deposit that you buy, it cannot be wildly volatile, because you know that when you will get your interest, and you know when this bond will expire. So you know that the worst case scenario is that I will get this money 1.5 years down the line, and during this period I will get this interest twice. So it never goes down in value by 50%.
Right.
In equity, it is based on perception. Here is a company which makes 100 crore, and there is a possibility that it will make 1,000 crore. And then when that does not happen, that company makes only 50 crore and the price crashes. So that leads to massive erosion. The whole market goes crazy, or because of the noise, or many bad things happening at the same time. Something happens in the economy, something happens in the country, something geopolitical, and all that noise creates a large number of investors who get scared. And then we see the global financial crisis. Funds went down, equity funds went down by 80%, but bond funds go down. They go down by 2-3%. That is a calamity situation for bond funds. It never happens. So bonds are able to provide you the desired stability. Of course, it will not provide you the kind of stability that they can lose value, but they lose value in a narrow range. They don't go in a free fall, and so they are still able to provide you the stability of your investment. Balanced funds, they are not balanced fund now. The nomenclature has changed. Now they are aggressive hybrids, because they invest nearly 70-75% into equity. So this aggressive equity, they are nice for anybody who is getting started with equity. They are nice for retirees, because your tolerance, or when you see a 20% decline in value of your capital, it's not that heartening. So it can drive you out of the market. So don't worry, it's fine.
Okay. We have a next question from Rajesh. Okay.
Yeah.
Should I extend my PPF account by 5 years of maturity, or invest the proceeds in mutual funds?
No, not really. This is a very common question. Every time I have written about PPF, people get angry, because my advice is very simple. PPF is nothing but a 15-year SIP in a fixed income. And because of our generational connect, my father will be advising me that open your PPF account and be at it.
Right.
You never lose money. But 15-year time period, investing in equity in a not so great fund, you'll be getting 1.5 times, twice as much as the PPF. And doing a regular investment, doing a SIP over 15-year period, it can't get safer. Anybody who had done any SIP over a 15-year time period, the way you do it in PPF, you don't lose money. You lose money when you get up one fine morning in 2008 and think that everybody is making money, but you haven't, and so you go and invest money. Equity is also not risky if you do your SIP over 15-year period. Right. In fact, in a fairly average fund or a below average fund, you'll be generating more returns on a 15-year period. Make sure that you are not taking the maturity proceeds at one go, because you will be you'll be connected to you will be attached to a value that, okay, my accumulation is 48 lakhs, and if it goes down by a lakh or two in a certain month, which you'll be able to have. So spread your investments over next 12 to 18 months if it is a large corpus, and start doing your SIPs. And any new investor who is considering opening his PPF account and filling it up with mandatory 1.5 lakh rupees, consider the tax saving fund as an alternative. Consider an equity fund, because 15-year time period, regular investments, you will have 1.5 times, twice as much more than what you will have in PPF.
Right. Padma has written in, I'm 54 years old and just started to invest in monthly income. where should I invest? Pretty much the same, the first question.
Yeah, and this is actually
this is again 5 years left.
6 years left. Yeah. So, but I don't know. Depends on the condition, and also there are a lot of variables. Will she have the pension coming in? Will she have any other income coming in? What will be her income requirement? Will there be a need for a large spending needed at this stage? Or you need to build your house, you have made your accumulation. What is the state of accumulation of your savings?
So as you said, aggressive planning is required, as you
aggressive planning is required. At the same time, somebody who has not been used to the market linked investment, they also need fairly strong hand holding with understanding. So look out for more of our Hangout session. There are many of them, on our channel available. Look for the way to approach things. Listen to as much as possible, so that you know what we are talking about, what you need, and you also have a framework you can derive from many of our Hangout sessions. How to go about planning things. You have a basic framework in place in terms of and dividing it in equity, debt, and how to approach it. If you still have time, if you are still working, you still have 6 years. Planning and aggressively reorganizing your finances can actually provide you the needed confidence and the money.
Right. Rajiv writes, can I redeem only the profits which have accrued on my mutual fund investment?
Why? Because this is actually comes from the background that somebody just drifted, just went past the market, invested, sitting on gain, and the market becoming shaky. Now I think, okay, let me take the gains out. What happens to your capital? The remaining capital will go down by 10-15% if market goes down. Become a good investor, and becoming a good investor is fairly straightforward. Decide when do you need the money. If you need the money, by all means take all your money out. But if you don't need the money, just taking your money out for the heck of it because you think that the market has become turbulent, it has become shaky, and you taking a part of the gains will be good, it's not a good idea. Work on a plan, be at it, and make that plan work.
Ramanath seeks your advice therein.
Yep.
I'm 71 years old and have been earning good dividends from my mutual fund investments. Should I switch to growth option?
Yes, that will boost your income by 10%. Because ever since this year's budget has clamped 10% capital gains tax, and for the dividend plans it has there will be a dividend distribution tax of 10%. So if you are getting 100 rupee last year, and if all the funds give you the same dividend, this year you will get 90 rupee. If you move your money to growth plans, and if you actually get into the systematic withdrawal of the amount that you require, it will actually be it will be better. The other advantage will be you used to get dividend not depending on your requirement. You used to get dividend when the fund decided to pay you. Sometime it was more, sometime it was less, and broadly you were happy. Plan a little bit. All the money you can move to a couple of growth plans of a balanced fund or an equity fund. Decide on the amount that you require every month. If that amount that you require every month or every 6 months or every year, all of it put together, your annual withdrawal does not exceed 4-5%. Do it in a withdrawal plan. It will be more tax efficient. You will have more money left which will be working harder.
Is there an upper cap on the investment amount for an individual to invest in mutual funds? Asks Abhishek. No.
No. Invest as much as you can. Yes, there are certain restrictions, where fund companies will not allow you to invest more than a certain amount. Funds are not allowed to have one investor which accounts for 25% of the fund. Okay. So there's something called 20-25 clause in the mutual fund regulations, that a mutual fund company must have 20 investors. Okay. And no single investor should account for more than 25% of the money in a fund. So if a fund is 1,000 crore fund, and if you are going to invest 300 crore in that fund, it will automatically trigger redemption, winding up of the fund. So otherwise, there is individually, I think, for individual investor, there is no such restriction.
Okay. Last question in today's program. Venkatesh says, is the entry or exit load charged when we switch from dividend reinvestment to dividend option?
No. There is, in fact, on all Indian mutual funds, entry load was abolished a couple of years back. Few years back. So there is no entry load anyway. Exit load is also actually not exit load. Exit load is something called contingent deferred sales charge. So exit load works in a manner that if you hold your investment for 1 year, or if you hold your investment for 2 years, or if you hold your investment for 6 months, there will be no load. And if you redeem before that period, there will be a certain charge. So it is contingent on your period of investment in a fund. So, but you're coming to your specific question, dividend reinvestment to dividend option or dividend option to dividend reinvestment option is a non-financial transaction. So there is no exit load levied on this transaction, this change.
Okay. Well, that's all we have in today's program. Dhiren, thank you so much for answering the questions of our viewers. And as regards the exit policy, make sure your strategy should include 6 to 12 months before the expiry of the goal.
Yeah, before you need the money.
Before you need the money.
Yeah.
Keep investing till we meet next time. Bye from all of us. Take care.